keep things moving and get to our main focus point today, which is about choosing between dollar cost averaging and value averaging. Now, we talk pretty frequently about the former, and you may not know what the latter is. So when would you use it? What does it mean? And how might it help you? Now, at a high level, this is an important thing because market timing can be risky. Investors who are waiting for dips or think they're pulling out at highs can often find themselves in a worse position than where they started. And so if you're waiting for what you perceive to be a bottom, perhaps you can get left behind. And so we've mentioned this concept, I would say pretty frequently on this show. The first one, dollar cost averaging. And so dollar cost averaging, is a refresher for all of you who may not know, is when you have a dollar amount that you want to invest in the market or invest in a stock or invest in what have you, and you set up fixed amounts at regular intervals. So why is that beneficial? Well, you don't know what the price of something is going to be tomorrow. And so if you are buying something, a little bit of it today, and tomorrow the price falls and you buy more of it, you are lowering your average acquisition cost. You are spreading those purchases out over regular intervals and giving you the likelihood of having a better investment experience. And this works very well with volatile assets, ones that are moving up and down pretty frequently. It helps you smooth out that acquisition cost. And so that one's pretty common. So what's the other one? Value averaging. Well, value averaging is in a way a similar concept. But instead of having regular intervals and regular amounts that you're going to invest over a period of time, value averaging means when assets move down, you buy more. When assets move up, you still buy, but you buy a little bit less. And so if you think of that, right, you're thinking about if a target portfolio should grow by $500 per quarter and the stock rises, then the investor would add less of it. If it falls, then the investor is going to start to add more of it. And over time, if you have the cash available to invest in downward movements of assets, it gives you a likelihood of higher returns should that stock price move upward. And so what are the pros and cons here? Well, for dollar cost averaging, it's pretty simple, right? It reduces risk. It's ideal for passive investors. It lowers that average acquisition cost. But it could be the case that after your first purchase, things move up. If you had put all of that money in at the beginning, you would have more in gains. But this is a probability game of giving you the higher likelihood of having a better investment experience. Now, for value averaging, where you buy more at the lows, you have higher potential returns. The other side of that is, well, it requires a lot more active management. You need to watch these names, these funds, these stocks, these bonds, whatever you're investing in, and you need to be more active about it. It means that you need to hold more cash. You need to have that cash available for downturns, which may or may not ever come. Now, if you think about dollar cost averaging, right, there's a way that a lot of us automatically do it with DRIPs, dividend reinvestment plans. And so what that does is that effectively continues to buy over time and lower that acquisition cost. So the question here is, is dollar cost averaging right for you? Is value averaging right for you? I think it comes down to this. Dollar cost averaging is more suitable for passive, steady investors. Value averaging benefits those with cash that's sitting on the sidelines, ready for dips. But both of them generally work for long-term growth. Now, the key takeaway, stay invested. As always, avoid emotional decisions because we say it all the time in the market beats timing the market.